Greetings, my name is Ted Hicks. I'm the Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, the 16th of June. And in last week's video, we talked about some of the improving breadth that we are seeing in the stock market. That breadth has continued to improve this week. If you want more details, you can watch last week's video. But I also promised this week that we would review some of the economic data that we're seeing and also talk a little bit about the differences between the two. So that's our brief agenda for today. So we'll start by looking at inflation, officially the Consumer Price Index. This statistic was updated earlier this week by the Bureau of Labor Statistics. And you can see on the screen that my data says 4.1. The official data is 4.0. So the bottom line is inflation is indeed coming down. That's good news. Let's look at a little bit more of the detail. And what I really want you to see is these negative numbers in here. This is energy. So what we're starting to see is the prices of energy are coming down, and that was what was really causing the inflation. That is now we are seeing deflation. Those prices are coming in, and that's helping the overall inflation statistic. So the good news is inflation is coming down, and that is one of the many reasons why the Federal Reserve earlier this week decided to pause. They did not raise rates this month at their conclusion of their two-day meeting. And again, the reason they didn't raise rate is they're seeing some data that suggests inflation is indeed coming down. However, let's zoom out. Now on the screen, we have this same inflation data, but you can see on the left-hand side, I've got data going all the way back to 1985. In addition, I've added this red line. The red line is a 10-year average of this data. So the good news is the inflation data has come down. Consumer Price Index is year over year. It's now at about 4%, which is dramatically different than the 9% peak that we saw not that many months ago. However, the 10-year average is close to 2.5%. And so here's the point. The good news is from an economic standpoint, the inflation data has indeed started to come down, or continued to come down, I should say. However, from a financial planning perspective, that difference between 2.5% inflation to 4% inflation, long term, that can still be very, very damaging. So we still have to do some work to do to get that inflation statistic a little bit lower. And the Chairman Powell of the Federal Reserve Committee did indicate that he expects that they might very well raise rates a couple more times throughout this year. Their target is they want to get closer to 2%. Now, again, from a financial planning perspective, because that's certainly a large part of what we do for our clients. It's yes, we manage money, but we're managing money for clients we're also doing financial planning for them and trying to forecast into the future. Is this particular client? Are they positioned well, etc.? Well, when you run a long-term financial plan and you change one data point from 3% inflation to 4% inflation, the effects over the life cycle of a financial plan are very dramatic. That 1% doesn't seem like much, but over a 20, 30, 40-year time horizon, that is actually very, very damaging. So good news is the inflation data is coming down. Bad news is we still have some work to do. On the screen right now is the federal funds rate. And as I indicated a moment ago, earlier this week, Chairman Powell and the Federal Open Market Committee announced that they are not raising interest rates for this month. Now, the reason they have been raising the interest rates is to combat inflation. And as I have shown, the inflation rates have been coming down. And so there's an argument that they are succeeding in their mission. So here's a little bit more evidence that they might very well be winning this battle. On the screen now is a screenshot from the Federal Reserve Bank of Cleveland. And what I want to highlight is that they are forecasting the next inflation number will be 3.2%, which is a further decrease in the overall inflation rate. As we are trying to head down to that 10-year average of 2.5%, or preferably the Federal Reserve's target of 2%, it seems like their efforts are working. So as we wrap up this week's video, just a brief comment on the difference between the economy and the stock market. Remember, they are not the same thing. The stock market is a leading economic indicator. So the stock market is advancing. That doesn't mean the economy is perfectly healed. That doesn't mean that we don't have any economic concerns. We have a lot of economic concerns. But if the stock market is advancing, our duty as fiduciaries is to help our clients participate in that rally in as wise a manner as possible. Now, one of the things that we have been talking a lot about is the lack of breadth. And again, in last week's video, and I touched on it very briefly today, that breadth has been improving. And one of the analogies that I've been using this past week in talking with clients is ice on a lake. If there's ice on a lake, does that mean that you can play ice hockey? Well, if that ice is thin, no, it's very dangerous. And so that's really what we've been seeing is the stock market is rising, but that's really thin ice. Earlier this year, it was really thin ice. And so our duty is to participate, but we have to participate safely. We have to participate intelligently because it's on thin ice. Well, as the breadth has been improving, think of that ice. That ice has been getting thicker and thicker. All right, well, now it's a little safer for us to actually go out on the ice and play ice hockey. So again, the stock market and the economy are two different things. The economy still, there's a lot of economic concerns that we have. But if the stock market is advancing, that's giving us some indications that the overall economy is improving. And based upon the inflation data that we are looking at today, it seems like the Federal Reserve has been succeeding in their mission to get inflation under control. So anyway, I hope that helps. If you haven't already, we would love it if you would hit the subscribe button on our YouTube channel. By all means, feel free to share these videos with your friends. We do have the office here in Cary, North Carolina, as well as an office in Southern Pines, North Carolina. But in today's digital age, we serve clients in a fiduciary capacity all over the country. So if you'd like to chat with us about how we might be able to help you and manage money proactively for you or do financial planning for you, whatever it might be, by all means, feel free to reach out to us. You can find our contact information at Hicks-Associates.com. Till next time, thanks for watching.